Today, I want to cover bootstrapped startups versus funded startups. Now, we need to set some ground rules here and some basic understanding of what we're talking about. Bootstrapping comes from the term pulling one up by their own bootstraps, which is a physical impossibility, I think. Bootstraps are little straps on the back of your boots that help you put your boots on. Okay, we get it. Bootstrapping is like you can pull yourself over the fence with your bootstrap. It doesn't exactly make sense, but the term basically means you're able to create a company off of either sweat equity or revenue that you immediately start generating. So what are examples of that? A consulting business where you say, I'm willing to charge you $100 for every hour for me to be a consultant to you. Well, immediately, if you sell 10 hours a week, the company's got revenue on day one. It is really easy to bootstrap. And all it requires is, if you're going to be in one of these venture capital categories, all it requires is that you are a designer, a developer, or somehow a business, a salesperson, a marketer, one of those skills. And you kind of need to have all three of those, to be totally honest, to get most of these companies off the ground. That's why a lot of accelerators like Y Combinator or others insist on having a developer on the founding team. If it's a technology company that's high growth, how are you going to have a technology company that's high growth if you don't have a developer? You're not, in all likelihood. And if it's an outsourced development shop, that's a red flag. Why can't you get a developer on your core team? Why can't you be a developer? And so there is a bias against people who are idea people. There's a bias against marketers. There is a bias against idea people or quote unquote business people. In fact, I've heard many venture capitalists say business person means no skill, that you have no skill. You're just an MBA with an idea. Maybe you can build a model, etc. Now, you do need to have leaders to hire everybody and bring the band together. So I don't necessarily feel that way. But I think a lot of people in Silicon Valley think in order to be successful, that management team, those co-founders at the start need to be developer, UX designer, product manager. There's a lot of different names for basically the person who architects conceptually the product manager, PM, UX, UI designer, user experience, user interface. Those are the terms that and the titles that people get excited about when they see a team. So if your team was an idea person, like I am, let's be honest, I'm kind of an idea person and a marketer, business guy, that's fine, but you need to have a collaborator. And I did. Brian Alvey was my CTO and my collaborator on Weblogs Inc., and that made me go a long way. And I had Mark Jeffrey as my CTO when I did Mahalo and then moved on to Inside. So and I was also a product guy. So having a product person, a designer, product person, sometimes those are two different skills, by the way. You can have a designer who just makes things beautiful and a UX person who works on the user interface and how the product flows. But you do need to have that in order to bootstrap, because the worst case scenario is you give money to a startup, they hire an outsourced dev firm. The dev firm says, okay, you stop paying us this month. You've been paying us for 10 months. The product's out. And then the product doesn't work. There's no developers to work on it. And the company goes backwards. So one other caveat here is something called friends and family money. Friends and family money is when you are not qualified to get venture capital and you go to your friends and your family, your associates, maybe people you've worked with, and say, hey, I'm passing the hat. I'm trying to raise money. And then I'm going to take that money, I'm going to hire people. And maybe you can, with that friends and family money, kickstart the project to get enough traction to get into an accelerator or to get venture capital. Pretty hard to do. Not everybody's got the rich uncle or rich aunt who are willing to throw $100,000 or $250,000 at a project, but some people do. Some people will keep their day job. There's another bootstrapping technique. Keep your day job and build on the weekends and nights, or go to your boss and say, hey, I'm willing to stay on for 2 days a week, and I would like this consulting fee. And then the other 3 days a week, you work on your startup, or 3 days at your current company, 2 days on your startup. A lot of people will start the flywheel going that way, do their user interviews, understand customers, do their research, build their MVP. You want to have your landing ready before you take off, is basically how I would describe this. So if you're going to take off and go out over the ocean, you better have the landing in mind, and you better have enough fuel. Fuel in this case would be your personal runway. Personal runway would be, okay, you've got $5,000 a month in bills and payments and rent and whatever. okay, it's going to take you 18 months to build this company out to the point at which you get venture capital. Do you personally have 18 times 5? Do you have 100 grand, 90 grand, 100 grand, 110 grand with a buffer in your bank account to keep you solvent while you spend a year and a half of your life trying to get this startup off the ground? And I did that. A lot of my startups, I was working as a consultant, or I had a little bit of cash from the previous project in my bank account, or I went into debt, which is very dangerous, and not for everybody. But there is risk. You're not entitled to be a startup founder or get venture capital. You must understand this when you come to the table and decide you want to work in this space. So we talked a little bit about bootstrapping versus VC. If you bootstrap, the longer you bootstrap, then the less dilution you will have to your cap table. So let's pause on that for a second. If you raise money from that friends and family round and you raise $250K, you might get a $2.5 million valuation. You've given away 10% of your company for that $250. Now, if you find a co-founder who's a developer and you're a designer UX person, you don't need the $250 because you're not going to give it to an outside firm. So the two of you just build it on the weekends or nights. Now you have no dilution. Now you get the product to a prototype phase and you go to a seed fund or an accelerator and you raise $100K for 6% of your company at an accelerator, or you get a seed fund to put $250K, $500K in, let's say, at a $5 million valuation. Well, now you got to the product done and you got $500K and you diluted 10%, as opposed to in the previous scenario, you would have spent the $250, gotten the product to launch, and then taken another $500K from a seed fund and diluted another 10%. In other words, you would have given away over 20% of your business. You would have less than 80% and you would have raised $750. The longer you can push out the funding and the more you can accomplish with less, the less funding you have to do. We call this a Pegasus, or I came up with the term Pegasus. So there's unicorns, companies worth over $1 billion. But a Pegasus for me is a company that flies over through the wings of bootstrapping. They fly over funding rounds and they skip funding rounds. And I encourage you to think about, how can I grow this business so strong that I can skip my next round of funding? It's very out of favor right now. Everybody loves to raise funding. It's such a hot market in 2021. Valuations are high. Why wouldn't you take money off the table? That's true. And that is a true statement. Money is sloshing around everywhere. People are raising money at very high valuations. I don't blame them for doing that. A lot of advice is situational, right? So I'm giving you this advice based on a certain situation, which would be a normal market. In a hot market, yeah, if you can raise money at a high price, in the same example I just gave, if you were raising that first $250 at a $10 million valuation, it's only 2.5% dilution. Who cares, right? So that would be a de minimis amount of dilution. You can go for it. But some companies like Webflow, Bubble, Calm.com, Notion have skipped rounds of funding. And we were involved in Calm.com and we watched them skip 2 rounds of funding, 3 rounds of funding. And that meant our percentage ownership, along with the founders, was very high because we didn't dilute. And then as the company became worth more and more, we didn't have to put up a bunch of pro rata. We didn't have to keep investing to keep our percentage ownership. And that was amazing for everybody. Every startup needs business insurance, and you should look no further than Embroker. If you don't have insurance, you failed one of the first steps. Embroker technology saves you time and money. Prices are up to 20% lower with better coverage than the incumbents. You can go from sign up to quote and purchase in just 10 minutes. When you work with Embroker instead of business insurance incumbents, you're not dealing with large, slow corporations. Plus, the sign-up takes days, not weeks, and the process is transparent with no opaque pricing. Here are 4 crucial types of startup insurance that they cover. And you're going to need all 4 of these in all likelihood. Cyber insurance, in case you get hacked. D&O insurance, so if your directors and officers do something dumb and you get sued, you're covered. You have E&O insurance, which covers errors and omissions. That's what the E and the O stands for. And it helps you scale because many major customers will ask to see your E&O insurance in order to close a deal. And of course, EPL, Employment Practices Liability. This covers harassment, wrongful termination, and more. To instantly buy custom-built insurance for startups, go to embroker.com/twist. That's EMBROKER.com/twist. And while you're there, get an extra 10% off using the offer code TWIST. You guessed it. Okay, let's get back to this amazing episode.